Okay, picture this. You're watching the biggest companies on Earth collectively decide to spend hundreds of billions of dollars on infrastructure they absolutely do not need right now, except they do. And when that happens, everything changes. Welcome back to TechMeHome, MarketPhase Daily News. Today is Thursday, May 14th, 2026, and the market just handed us a masterclass in how capital allocation actually works in the real world. Let's go. The headline everyone's talking about is Cisco. Not because Cisco is sexy or trendy, but because Cisco did something that matters more than any earnings beat we've seen in months. They proved that the AI Capex supercycle isn't theoretical anymore. It's real, it's accelerating, and it's translating into actual revenue. Cisco posted record earnings and revenue beats driven entirely by enterprise demand for AI infrastructure. Not software, not services, hardware, networking gear, the unglamorous backbone that makes AI actually work at scale. Their stock hit an all-time high. And here's the thing that should matter to you. When infrastructure vendors start reporting like this, it means the money is flowing, real capital, real spending, and that spending cascades down through the entire ecosystem. Think of it like this. Imagine you're at a casino, right? One massive whale just sat down and started buying chips. Thousands and thousands of chips. Every other gambler at the table sees that and thinks, oh, this is serious, this is real. That's what happened today. Amazon just announced they're committing $200 billion to capital expenditures. $200 billion, primarily for AI and cloud infrastructure. This is not a suggestion. This is not an experiment. This is Amazon saying to the entire world, we are building the future of computing, and we are not slowing down. When a mega cap like Amazon moves, it validates everything. It tells investors that the AI narrative isn't just hype, it's industrial reality. The Capex supercycle is still in its early innings. That means more Cisco-like beats are coming, more infrastructure orders, more revenue growth for vendors nobody's paying attention to yet. Now, let's talk about the broader market backdrop, because today wasn't just about Cisco and Amazon. We had the Trump-Xi summit kicking off, and you know what that means? Trade optimism, uncertainty when it disappears is a drug for equity markets. Investors were pricing in reduced tariff risk, which means corporate investment decisions get easier. When CFOs aren't terrified about tariff surprises, they spend more freely. They hire, they expand, they buy Cisco routers and Amazon cloud services. Futures across the Dow, S&P 500, and NASDAQ all climbed on this backdrop. The market is positioning for trade progress. The market is positioning for sustained corporate profitability. And here's the cynical part. None of this actually requires a deal to get done. It just requires the perception that things won't get worse. That's how the market operates in 2026. Perception is half the battle. Speaking of perception, let me talk about something that directly affects your wealth in ways you probably aren't thinking about: currency. The US dollar is still the world's reserve currency, but for how much longer? If you're not diversified away from pure equities and fiat holdings, you're making a bet that the central banks will never print their way into debasement. That's a dangerous bet. Consider precious metals. Consider small allocations to gold and silver as portfolio insurance. That's not fear-mongering, that's math. Gold miners just reported record Q1 results. Aris Mining, Fortuna Silver, they posted earnings that were driven by elevated gold prices. Barrick and Equinox are maintaining strong guidance. Why does this matter? Because when geopolitical risks persist, when macro risks hang in the air like smoke, gold acts as the ultimate hedge. It's the insurance policy that actually pays out. And right now, gold is having a moment. Profit margins across corporate America are expanding, and this is critical. Companies aren't just beating earnings because the top line is growing. They're beating because they've got pricing power. They're passing costs through to customers. Customers are accepting it because the alternative is doing without. That's the bull case for earnings resilience despite all the rate concerns floating around. Even regional consolidation is happening. Allegiant Air just completed a $1.5 billion acquisition of Sun Country Airlines. M&A activity is a sign of confidence. It's a sign that operators think the future is worth betting capital on. So here's what all of this actually means for you sitting at home. The AI Capex cycle is real. It's not priced in yet. When Cisco beats, when Amazon commits $200 billion, when trade sentiment lifts, that's not noise, that's signal. That's the market telling you that corporate earnings are going to stay elevated longer than the bears expected. That doesn't mean buy everything. But it means the structural backdrop is bullish. It means the dominoes are falling in the right direction. The question is whether you're positioned for it, or whether you're sitting on the sidelines waiting for confirmation that never comes. That's your market summary for Thursday, May 14th, 2026. Stay tuned to TechMeHome for tomorrow's daily news. None of this is financial advice. It's purely for entertainment purposes. Always do your own research and consult a financial advisor before making investment decisions.